Okay, welcome to another Rich's Roadmap to Wealth.
Formerly known as Basement
Oh
Tales.
no, I kept doing that. Yeah, which we've had some recent ones that were very basement taily. I
Yes,
would say this is much more of a Rich's Roadmap,
for
and they
sure.
overlap certainly.
For
It's the
sure.
same people that do that. So this is a good one. I think people will like this. If you're interested in real estate flipping and buying and renting and all of that stuff, you've probably heard the phrase "subject to." What the heck is subject to? And I think you'll hear, we'll probably start with Charlie, that people view it correctly in many regards as a way to get low interest rate mortgages like the good old days. We've been stuck in the 6 to 7% range, even for very good credit risk
Sure.
mortgages and high percentage payments. So people are like, boy, if I could get a 3% mortgage or 3.5%, I could afford a lot more house.
You
Yeah.
can't do
And
that, can you?
well, it turns out I
Oh, you
think you
can.
can.
So is it you,
Oh,
you
you
assume
can.
the mortgage?
Well, how does
Do
it
you
work?
assume a mortgage now? What are
Well,
you talking
well,
about?
there's two things.
How do you? I mean, start with what are you looking for? What is what? It, I
All
don't
right,
know. You're
so
good at explaining
so
it.
there's two pathways, right? Pathway number one is what you just said: loan assumption. VA loans, for the most part, Veterans Administration loans, FHA loans, they can be. Some of those loans can be assumed.
So that means if I have the existing house, I could sell the house to Sam, and
And
Sam,
Sam
could
could
assume my
assume
loan,
your loan.
and
Do
I'm
I have to
out.
qualify for
Yeah,
this
but that's the
loan?
thing. There's a process for you to qualify for that loan. So, but it's a two-step process, right? Because you got to qualify through the government agency that's doing it, FHA or VA. But VA is for veterans, but you don't have to be a veteran to assume a VA loan. So anybody in the public can assume an FHA loan or a VA loan. So you got to get it approved two ways. Number one, through the government agency, and then number two, through the loan servicer. You got to get qualified. DTI, debt to income, can you afford the house? And then what happens is when you close on the transaction, the deed goes from Ed to Sam, so you own it, you're on the deed, but the loan gets out of Ed's name and it goes into your name. That's a loan
So you
assumption.
become Ed, as it were.
Yeah.
Really,
Yep.
the whole thing. And the other thing to remember about VA stuff, isn't it, that if I am a VA owner,
Right.
and I give my or allow my loan to go to Sam, it's all approved. Don't I give up my entitlement? So if I want to go
Yes.
buy another house, I
You
can't use the VA system.
No, you can. You can.
You can.
You give up a percentage of your VA entitlement.
I see.
So let's say the VA entitlement, I'm making numbers up, but let's say it's 1.2 million. Your loan that Sam is assuming is $500,000.
Oh, okay.
You're giving up the 500,000 of your entitlement. You still have $700,000.
Oh, I didn't realize that. Yeah.
However, that's assuming if Sam is not a veteran. If Sam was a veteran, assuming your VA loan, then you get 100% of your entitlement.
I utilized mine.
Sam's utilizing his to assume your loan.
Interesting.
Yeah, if I pay off your loan afterwards too, it
Thank
goes
you.
back to you.
That would make sense.
Your
So-
entitlement.
So, and this, of course, is well, I get. Is it subject to? Not really the way
No, no,
we
no, no.
think
No.
about it.
No, that's the assumption process.
Right.
Now,
And how? And let me, before you get right to the subject too, how common is that? I'm really curious. Do you?
It used to be
see-
very, very common in the
well,
ni-
back in the
90s.
70s and 80s and
Yeah,
90s,
yeah,
it
yeah,
was.
yeah.
But
But
then
not
once
now.
interest rates skyrocketed, right, over that period of time, it was very uncommon.
Yeah.
Now, as interest rates kept coming down, there's no sense for somebody to assume a loan because the interest rates were higher than the existing market.
And FHA changed their rules.
And FHA
And-
changed.
And so FHA, you may be able to assume some of them, but you do have to qualify for any you assume. In the old
Right.
days, there was not that part of the process.
You didn't have to call it right.
So then that raises. Charlie's not just going to sit there and say, "I'm not going to make any money buying and selling houses."
we're gonna make
He's
some
gonna,
money.
He's
So
going to
that's
grab a house.
Oh yeah, we're gonna
subject
make
to.
we're gonna make some money.
So how do you grab a house, Charlie?
All right,
and get
so-
get a good loan.
All right. So now the next step to that is outside the assumption world is this thing called subject to the existing mortgage. Now, what that does is the buyer basically takes over the payments of the seller's loan. However, the loan stays in the seller's name, but the deed gets conveyed to myself, the buyer. And so I'm buying the house subject to the existing mortgage. Now, there is no qualification process for me to subject to that loan. I just start making payments.
Now, does the loan go into default when it changes ownership like that? What happens? How does what does the bank think?
Because
Right.
you were talking about qualifying with VA.
Right, there's no
and all
If the
qualifying.
bank doesn't
Nothing.
allow for that, how does this all work?
Right. So there's what's called on the deed of trust. There's this thing called a due on sale clause.
Could be, not
Could
guaranteed
be.
to
So
be on there.
the bank or the investor has the right that once the ownership changes, they can call the loan. So it's called a due on sale clause.
And the reason it's optional is that loan still is secured by that house.
That's right.
Even though it's changed from, again, Ed to Sam, Sam's going to lose the house if that loan is not paid, because that lien is still good. It has not gone away.
Right.
But the bank may not want to deal with
That's
that.
right. That's right. So let's talk about that, right? So the question is the due on sale clause. So anybody doing a subject to transaction has to know about the due on sale clause. Now, out of, let's say, 100 sub 2 loans, we've only seen this happen maybe 1 or 2 times.
That the loan was called by the existing lender.
Right, right. So all of the institutional lenders, like, for example, a conventional loan with a big bank, Wells Fargo, Bank of America, Capital One, whatever the banks are, or Fannie Mae, Freddie Mac back loans, or VA, FHA, VHDA, which is the first time Virginia Home Program, we've never seen one of those loans call in a due on sale clause. Now, the question is,
And even you have done or seen people where they've done that assumption when the loan was in foreclosure.
Yes.
So the bank's already
Yes.
like behind. It gets cured by the purchase process. So the bank's happy at least that it's been brought cured, and then they go back to sleep, I guess is what
they go
you're
back to sleep
saying.
because they
Yeah.
would much rather have a performing loan
Right.
than a non-performing loan.
I like that. I like that. I have another question. Legal. This might
Oh,
go
no.
on the legal.
Wait a minute, hold on.
Okay,
no,
we're
no,
not
no,
done
no.
there?
Caveat it. You're a lawyer, aren't you?
Yeah, but I'm not your lawyer.
Thank you.
No, I am your lawyer sometimes.
But yeah.
Well, here's a question for you. Let's just say that you bought a house subject to,
Right.
and you had a very normal transaction with an older person who was not in the housing market any longer, and they're fully aware of it, and they've agreed that you can make.
Well, wait a
payments
minute
on their
though.
mortgage.
They better be fully aware of it
Right,
because when you go to close,
right. You're not paying.
there had
for
better be a 2 or 3 page document that discloses all of this. I hope.
Yeah.
Yeah. So you got all of this awareness, and everyone leaves the table, and it works out well for them. And then you're making payments in the normal course on their mortgage, and you've even caught up their mortgage. You've cured all the problems that were with it, and it's gone on a couple months. And then you get a notice in the mail.
Ooh, I like this.
You get a notice in the mail. It says that a payment is due, and you're like, why am I getting a notice in the mail when it's set up for automatic payments? So you log into the system, and then the system isn't there anymore. It just says that a payment is due, but you can't pay online. And then you look more closely at the notice, and then you notice that it says, this is the amount. This is not a bill. This is just a notice because you filed a bankruptcy. So the person you bought it from turned out they had some other
This
debts
is a
you were
great
not-
question.
This is a great question because it's one that's actually happening as we speak. So
Oh, you mean we have a house that we did a substitute
yeah,
on?
and then
Really?
the guy
we
went-
buy them, and
yeah,
Ed
then-
buys them.
then
We
Ed
all buy
go-
them.
Yeah,
Sub
so
twos.
this is our
Interesting.
subject to that we currently
So
have.
you're just not talking
So I
because
just
you're a
took
theory guy.
I took a check. Charlie style, and I
Yes.
just hand wrote that check out and put it
Yes.
in an envelope, and I mailed it to these
I
people
love this country.
to the non-bill address. And I expect that maybe they'll send me another bill. This just happened last month.
Well, no,
And
no,
so
no.
I don't
Hold
know
on.
what's going to happen?
Hold
for
on,
the
via-
first,
no,
this
no,
coming
no.
month. I'm just waiting to see if they
No,
send
no.
me
Via
another bill.
Charlie. No. Via Charlie style. Did the check get cashed? And do you know that because of the
No,
bank
I didn't
image?
check it.
Charlie
I didn't
style?
check it yet.
okay.
So we're not far enough along. This just happened. So what do? This guy's in bankruptcy. We're just going to make payments on this house until someone says otherwise. But they don't have any equity interest in it. The bankruptcy trustee doesn't.
It's interesting. I haven't heard of that before, but in the way the bankruptcy, it's not uncommon for a secured asset that people continue to make those payments in bankruptcy.
Right, that's
yeah.
pretty common,
with
right?
everybody's
Yeah,
with
it's pretty
everybody's
common.
knowledge, yes, because they figure their problem may be more credit card debt or medical debt or
Yeah,
whatever.
Sure, it probably is.
And
yeah.
so that's one of the purposes of Chapter 13 is to work out all those debts and who gets paid. But what this creates a real issue is, are they going to think that the house is an asset of the estate?
Well, they may think
They
it,
just
but then
may
they'd
assume
look
it.
They'd have to look at when the guy fills out the forms.
Right.
He's going to not be able to list it because he doesn't have a deed.
Right,
He's
right,
evaded.
right. And then the person who's in the bankruptcy, again, I'm speaking
No,
just generally, would
but he did.
probably.
But that's the thing. He didn't convey it.
Well, he conveyed the deed.
No,
Oh, he didn't?
it was a foreclosure auction. So there was a trustee sale deed that was recorded. In other words, this wasn't a normal sub 2 transaction with a title company.
Oh yeah, we did.
This
we went
was
all the way
a
through the trust.
foreclosure
Yeah.
on the second trust where
Where the deed was conveyed
Yeah,
to us
so
by
the-
the trust.
I
owner-
see. So the sub 2 became. So let me. All right,
Yeah,
back
yeah,
up and
yeah, that was-
explain
it's
to
a more
people.
complicated-
So
Okay.
in other words, in a foreclosure, not only your first main mortgage can foreclose, but if you've gotten like a home equity
That
line
can
of
foreclose.
credit, that
Yep.
can foreclose. And if that forecloses and is sold, the house is sold.
Which was sold to a
It's
third
sold.
party entity.
But then
We
any lien that's superior, that's earlier,
Has to be
then
paid.
that
Yeah,
lien
yeah,
has to be paid and it's
Right.
kept. So,
Right.
but so when the transaction happens and you get the house, you're effectively subject to the first.
That's
Yeah.
right.
In that
That's
way,
exactly right.
it's like
Yep.
it's like a legal subject to. And there, you're probably at more risk that the first trust would call it. But then again, if they're getting paid, they may have been getting paid throughout. They
We
never
caught them all up immediately. Actually, because we had an agreement
You had the
with
liability.
the prior owner. Yeah, we had the liability, and we paid the prior owner in order to give us their logins and allow us permissions to
right,
make
but we
payments.
didn't catch that loan back up until we
owned it.
owned it.
Correct.
Okay.
Interesting. I see.
And then we unhooked all of their escrows from it, so we just pay those bills separately, so we keep it all current. But now he's subject. He's bankrupt to either the company that owned it or his own personal self or whatever. I didn't look.
Well, see, in that scenario,
It's
and again,
strange, right?
speaking generally, I think what a person would probably do in that situation is say, the property, this property is no longer my asset. It's been sold.
Yeah.
And this liability by operation of the foreclosure is no longer my liability.
Oh, that's true as well.
Oh,
because
that's very true.
By the operation of the foreclosure in Virginia, they actually have a law that requires that we would have paid that off.
Right.
Now, there's not like a law like the police don't come to your house
Right.
kind of law.
Right.
That's not that kind of law, but
Right.
it's a law that if the bank called us and said, "Hey, you need to pay this off,"
Right.
I wouldn't hesitate. We wouldn't
No.
get into some like dispute over it. We would
Right.
just simply pay it off.
Right.
Even if they sent one letter that said, "Hey, we're aware that you're not on title. You've been making payments."
Yeah, but wait a
or
minute
whatever."
though. Time out. No, not
Yeah.
yet. Hold on.
Hmm?
Why would we not then try to assume the loan at that point?
No, we could ask.
You
them.
could ask the bank because
But they're a very uncooperative bank. I think it was like PennyMac or something like that.
and I think sometimes they have internal policies and government things where they have to have certain underwriting standards and they can't
Oh,
do that.
I see.
We're not allowed to assign it or
Yeah,
get
by the
some-
time-
Assume it, yeah.
Yeah.
but I would ask. But it's interesting. I didn't even, when we started this topic, it didn't even occur to me that subject to it's not uncommon that a second trust forecloses and then
Very common.
somebody becomes, and sometimes they don't know there's a first trust that they've
Oh,
now
that could
become
be.
subject, and they overpay for the house at auction because they don't realize that there's a first
Yeah,
trust that
yeah.
they've got to pay.
So it's
But-
a very nuanced thing, right?
Right.
I mean, it's easy to drill down and say, "Oh, I'm going to buy a sub 2 house," but there's all these other things that can come into play.
Right.
Like even in this one, we didn't consider the scenario of this potential bankruptcy, and it doesn't make the deal bad or something.
No,
But it is.
raises
new.
an issue.
So then we can talk about the two scenarios where I know of a bank has called a sub 2 due on sale clause and
really?
made, yeah. So this happened in, can I say the bank?
Probably better not.
Maybe
to.
not.
Yeah. But
Okay.
it's fine. I mean, they didn't
The
do
bank,
anything
the
wrong.
bank was SS, and they were acquired by AU. And this particular bank was going through a liquidity crisis because of some bad loans on Class B, Class C office space.
Yeah.
Oh, that's
So
common.
they had
Yeah.
to. So
Yeah.
they had to raise money so that the FDIC wouldn't come and
Yeah.
take the bank.
Yeah.
Well, there's only a couple ways to raise money. Number one, you increase deposits. So you make your money market interest rates higher than other banks to get more deposits in your bank. Number two, you sell assets, right? Performing assets or non-performing assets. Or number three, you go back through your list of loans that you have out there, mortgages, and you find out which
Go check the
properties
title.
changed hands.
Yeah.
You got a due on sale clause.
Yeah.
You call those loans.
Right.
Yeah.
So we know of a couple instances
Yeah.
where SS called their loans.
And that's an example.
That's the only time I know.
No, and that's an example of. I wanted to tell you a question I have about that in the future, but that's just an example that if you buy a subject to, it sounds like all roses and whatever. You have a foreclosure issue on that one. It's a little different that came up, but there is the risk that the loan will get called.
Yeah.
I mean, the person maybe who's agreed to do it subject to is like, it's showing up on my credit report, and then I have to explain to them that
Yep.
here's an agreement where it says this other guy's going to pay,
Yeah.
so don't ding they call up the original lender and say, would you please do something about who knows, or your scenario. And so then as the person who's bought the house, you're losing a lot of value. If that loan gets called,
Yeah.
you're going to either have to come up with the money to pay it off, or you're going to refinance the whole thing.
Yeah.
But instead of a juicy, let's say 3.5% rate, you might have to do an investment loan at 8%, 7 or 8%.
Yeah, but remember though, that shouldn't be that big of a deal because at the end of the day, you're buying into equity.
You're
You're buying
If you
into
bought it
value
correctly.
if you bought it correctly.
this
Yeah,
is
but
the
if
thing,
the
'cause
equity is all, if you're thinking my value is all in the subject too,
can't do it that way.
that's a problem.
Yeah,
an
that's a problem. That's a
an
problem.
enhancement.
Right.
That's a
And
problem.
That's what I think is. So
Yeah.
it's sub 2, I think, is an enhancement to transactions. It enables some transactions that wouldn't probably be working otherwise, but it's not the only strategy. Now, I know there's some successful people out there selling it as the primary line of education. They're charging $30,000 to learn about it,
Right.
whatever.
Right.
First of all, there isn't that much to learn. And second of all, it's not the only thing out there. Now, what's nice about it is it focuses your mind. If you're looking for sub 2, you know to look for those deals. And I think that's a value because it gets people directed, focused,
Right,
organized around a narrow thing. I think looking at our education platform, we just have talked about even in prior podcasts. There's a lot of variables, right? So you have to really get into it and understand many, many things that the way we approach it. If you go to a person who says, "Oh, I'm just going to do subject to," or "I'm just going to do a particular type of distress," that is a narrow thing to focus on, but it really limits what you can look at when you're looking across the market, because you might come upon a great opportunity that fits another category of distress,
Right.
other than subject to,
Right.
or you might
Well-
find something that's great for subject to.
Yeah.
Well, this brings me to a point, and you guys are going to laugh in that, and this is for the lawyer of the world.
Oh,
is
man.
that
You're another one.
we had a friend of ours that worked at Fannie Mae, and he came with us and worked with us for a little bit of time. DP, can't say his name. DP. So DP comes and works with us, and this is back in the days of Think Realty, and he was going to be our DC guy and find distressed assets in DC. Epic fail, by the way. He was the reason why we bought Q Street with the occupants in it.
Yeah. So,
And so we were, at the time, we were writing articles for our investors on Clear Sky Financial. We would give them a monthly newsletter every single month and how we did it.
Yeah.
There was a Sam's Corner and a Charlie's Corner part of these newsletters. Well, one of those months, I wrote an article about sub 2 on how you can do sub 2, on how you can buy a house, put the deed in your name, and just simply pay on the loan.
Oh yeah.
Well, because of his background with Fannie Mae, and he knew the due on sale clause, he got so mad at me because he didn't like the fact that I was publishing things that were illegal. And so, do you remember that when he got he
Yeah.
got really mad at me
Yeah.
for doing that?
Yeah,
And
yeah.
that was
It
sub
was-
2, and
yeah.
that was 7 or 8 years ago,
Yeah,
right? Maybe
but
longer.
again, not the kind of police involvement illegal. This is like a contractual
And even so,
violation.
I'm right. I'm not sure.
I think that's the wrong word.
Yeah, I think so. And we can talk about that some more. The one other thing I was wondering that might have why more of these might get called. I have 4 really good investor loans from this time period. So they're like 3.6%.
Oh, that's gold.
Of an investor loan, right?
But that's an investor loan?
Yeah, I got
Dude, that's awesome.
I hit the top of the refinance game. But Mr. Cooper is involved, and maybe they sold a Rocket Mortgage. I don't know. I get so many solicitations,
Of course,
to cash from them,
please,
to cash out. To take cash out and refinance. And the obvious thing is, A, they make money generally from that, but B, they would love to get rid of these
they want to replace your rate.
3.6%.
They want to replace your rate.
So,
yeah.
so I would think, especially if interest rates go back up, and a third of the Fed thinks they're going up next year. Not
I think
down.
I think they might go up.
Well, they did recently a little bit, but who knows, right? But more as banks get under more financial pressure, if that happens,
Yes, it will.
and or worse is if it's interest rates go up. Maybe maybe I should check through my portfolio and start calling these subject twos. And so you are at some risk, but I like your point about buying into equity, that it better not be you're in big trouble financially if the thing does get called. It's just too much risk to take. But in terms of illegality, I think if you have I would think, and I'm not giving a specific legal opinion, I have to look at all the documents, but if they have a contract between A and B, I mean, it even anticipates the scenario. It's saying if you sell your property, we can call it. Whereas they're
It
actually
has a solution within that document.
it has a
Well,
solution.
no. Here's the question, right? The legality side of it.
Mm-hmm.
I'm buying your house sub 2.
Right.
You're the one that signed the deed of trust that says a due on
the
sale
bank.
clause.
Right.
You have that obligation to the bank. I'm buying your house sub 2. I don't have any obligation to that deed of trust.
Mm-hmm.
Right.
So how illegal is it?
You're
Right?
a third party.
I'm a third party.
Right.
Yeah, and so the illegal or the rule violation.
Yes,
is
if that's what you
between-
want to call it.
is between the
seller.
seller and the lender. Now the lender has a recourse; they can just call it, and that's it.
Right.
And they
Essentially,
fix
there's
it.
no damage. Even if you
Right, there's no
quote, unquote,
damage.
harm, there shouldn't
If
be
there's
any
equity,
damage.
there's no damage,
Right,
probably. If it's one of these sub 2 deals where the house is worth $400,000, the loan is $395 or $390 with a 3.25% interest rate,
They may be damaged.
and you're buying it, right, and you're not transferring
the
any
other
money
guy
to
was
the
at
owner,
least
the other guy
keeping
just
it up.
goes away. You're just putting a tenant in there. Market goes to hell in a handbasket. It forecloses, then there's a problem.
It could be.
But if there's houses with equity, there's not going to be a problem, more than likely.
Well, their recourse on that loss is also defined in their contract document on the deed of trust.
Right.
with foreclosure, basically.
With foreclosure.
Yeah. Well, and I was trying to think broadly is, could they somehow say the bank that there was interference with the contract, but typically
Tortious interference?
exactly. 'Cause
Whoa,
there has to be a
whoa,
tort.
stop it.
Yeah, that's how many
Stop
times.
it.
That's how much
Stop.
education Mr. Grass has given.
What did
Yeah.
you just say?
Yeah, tortious interference.
What the hell is tortious?
Well, so tort is very simple. If I punch Sam in the face, I have committed a tort.
That's
I've
bad.
committed a crime.
That sounds like that's bad.
It's bad. Yeah, because Sam might turn around and say, I wrecked his beautiful face. His nose is broken and deformed.
But,
And
are torts always bad?
well, it depends if they sue you about it. But yeah, the concept of a tort is
Bad.
that you've injured somebody.
Something's happened. Okay.
And typically a tort has legal redress for that injury. Whereas in the civil context, usually you're talking about contracts and breach of contract. So they're really two different. So a breach of contract's not a tort. I have damaged you financially by not honoring my side of the breach of contract.
That is a tort, okay.
But that's not a tort. Where there's weird things, though, there's something called tortious interference with contract, where I think boy, I'm going back to law school here.
This is
but
great, by the way.
There's a classic scenario where, let's say you, Sam, are entering a contract with Charlie. And maybe you've entered a contract, and I say, hey, Sam, breach your contract with him, he's not going to sue you. Enter it with me. I'll pay you more money. And so I've been essentially tortiously tried to get him to breach the contract, which has
see.
injured you.
I
So
see.
even though you and I are not in a contractual
But you-
relationship, I've committed a tort
Tortious interference with me.
with your contract
I
with
see.
him.
Okay.
So there's pretty unusual, and usually that's very hard to establish. There's even, there can be tortious interference with prospective business relationship, but generally speaking, as I would look at it, the contract says, the contract could say, you can't sell this property without our approval. Doesn't say that. And in fact, because somebody could take a second trust, well, actually, a lot of times it say you can't put a trust over us. It's done all the time by large banks, and which can generate your scenario where the subject, well, I won't call it subject to, but the underlying loan is now sucked into a bankruptcy because of the second trust and whatever. So I really think that should be viewed as a contractual situation, and it especially when it maps out all the damages. Like, the problem is your deal with Sam and that tortious interference doesn't really deal with somebody else coming in and interfering and causing a problem.
Makes sense.
Like again, you'd have to then be damaged, because now I tell Sam, well, you'll have to pay him $1,000 in damages, but I'll do 10 contracts like this, whereas he would have done 10 contracts with you. So it gets confusing. But in any event, the general thing is, try to look into legal issues when you do these things to get
Totally
some
agree.
idea.
Totally agree. But I've got another scenario I want to bring up.
Yeah.
So that old Sam is sub 2, right? He owns a house that he's sub 2. He's the owner. The bank comes back and they send Sam a little message that says, hey, I know you're the owner, but I know you're not on this loan. I'm exercising my due on sale clause. Pay me my money.
Okay.
Sam, the owner, says, no, I'm not paying you your money. I'm going to continue to make monthly payments. Oh, by the way, I've got the greatest lawyer in the world sitting next to me, and I want him, if you think, number one, I'm not going to pay you back, I'm going to pay you monthly like I've been doing. The bank then has to file something in court.
They'd have to foreclose.
Right? They're going to have to do something.
Yeah.
But then Sam hires the best lawyer in the world. Are there any defenses to that due on sale clause where you could be the defending attorney? Because Sam's a rich guy and will pay you.
He loves paying attorneys.
Yeah.
Yeah. Well,
so is there
not only
can you scare them to say, oh, retract this?
Yeah, well, people can do all sorts of
Understood.
things. I don't think there's any. You have to have, as an attorney, what they call a colorable basis to make an argument.
What is it?
And
a what?
Colorable.
Colorable?
I don't know where the term comes from.
Is it as in a coloring book or cull?
No, like a
Colorable.
coloring book. Yeah.
Oh, we're learning a lot today.
So instead of colorable in this context means you have a somewhat reasonable argument. You can't just make stuff up. Like I can't.
No, but Sam's argument could be, I didn't sign that deed of trust. What are you talking about?
Well, but what's the basis for not honoring it? So in other words, what you go back to the agreement, and the agreement has provisions in it, which is there's certain events of default. You don't pay it as a default.
Yes.
You don't pay it at maturity. It's a default.
Yes.
You transfer.
There's a due on sale clause, and it's not paid.
Okay.
There's like other things.
I see.
All they have to do is foreclose.
I see.
So I'm not sure why you could argue to them, but it's their election, because, like you said, there's reasons why they want to get out of that situation.
Oh, for sure. The low interest rate.
Okay, but wait a minute.
This is a little bit like a scenario we know where somebody blew the maturity date but kept paying the interest,
I don't
which
know
is
what you're talking about.
Thanks very much. It's actually, at least it's not trying to hose you over completely, but the contract has a maturity date for a reason. The bank or lender does not have to extend that. They may have other needs for their money. So I can't, off the top of my head, I can't think of a good faith basis, a colorable basis to try to stop. I would certainly ask them. I would say, hey, if you think about it, I'm happy to keep paying this thing. But the other problem too is if they do a foreclosure like that, it's going to cause problem for the original borrower. And so the borrower who's is out of the situation, it's on their credit report.
Yeah.
I shouldn't say it's gonna. It could.
I see.
It could
Even
show
though the
up.
loan's being paid current.
Even though
Because,
because they called it, because they're foreclosing.
Okay,
on it.
so really the way for them to call it would be to threaten a foreclosure event.
Right, they would just do a normal probably default letter and say, we see that this
But-
is sold, it's due on sale.
but-
there we'll give you we're nice, we'll give you 30 days to pay us.
But they're obligated to send that default letter to the new owner. correct?
No,
Well,
no,
so in our case, we would see it because we are
in the
in the
system.
system as the.
But you just said you can't log into the system.
No, you can log in, but you can't make your payments online.
Oh, okay,
anymore. Your account's still there, but we're set up
Okay.
as the pay. They know about us.
Boy, the other issue is if the loan starts getting sold and then RESPA notices, and so there's a lot of weird things that could happen.
Strange stuff.
But yeah, no, they would basically. I'm just guessing because don't see it very often. The bank, lender A, would send to the original borrower a default notice and say, we
to the
see that you
original
sold it,
borrower.
it's due on sale, because that's the only person they know on the name.
To the
Now,
original
if you
borrower.
set up with the address so that the address
Which I
is to
did in
come
this
to you,
scenario. That's why I got the letter.
That's
then
important.
you would know. But where you're really, the main risk I think you have in that scenario is to the original borrower. Depending on your agreement, whatever, for goodness sakes, if it written it down, you don't want to hurt their credit.
No.
And so again, you have to operate in good faith in all of these things, because I think they might have a claim against you. Like, hey, I sold this subject to you take care of it. You're due. The loan is against the property. You got to pay it.
Yeah.
And you don't pay it. I realize they're going to I guess there could be even a deficiency judgment if I think about it. But if they foreclose on the house, the lender, presumably that would get reported to a credit agency for the original borrower.
I see.
Yeah.
Okay, so let's go down another rabbit hole. But you guys are gonna like this rabbit hole, and this is for both of you guys. Sam's favorite topic is AI. Okay. I've been warned or told that AI might cause a lot of different searches within the sub-2 space, where it will be able to notify the servicer and or the investor of which one of their loans has the title has changed hands, but the loan is still in the name of the other person, and here's the list. Do you guys think that this might cause a problem?
Well, that's the scenario where I said, like, they need to raise capital and
Yeah,
or
for sure.
interest rates go up, or both. It doesn't. I don't think it's that easy though to generate that data.
That's what I'm thinking
Let's
too.
say that they did generate it, and I was Bank of
Yeah,
America.
that's right.
What percentage of their portfolio is in this situation?
It's got to be small, right?
It's so small.
Gotta be small.
And their other problems are so big.
They don't
like,
get right.
Like that is the smallest thing in the
Well,
world.
because presumably
Right.
there would be taking a performing loan and making
Right.
it non-performing.
And they don't
you're
wanna
gonna-
do that.
You're going to ding your own portfolio and say, "Oh,
They don't wanna
want to
do that.
Right,
but that's the whole gist of it, right? But that's the whole gist of it, though, right?
Yeah. I
And
don't
why
think
this
that's a high
works,
risk.
right? And why this
This
works
doesn't fit
because
business.
financial institutions do not want to take a performing loan and make it into a non-performing loan,
I see.
Right.
even though the payments are being made.
Yeah.
They don't want to do that.
And I'm no expert on the background, but obviously I think people are aware there's different buckets that banks have. A performing loan is a separate bucket from non-performing.
But that's a
And
good
it can
bucket.
And it can get very complex because that bucket of performing loans may be sold to, shares
Yeah,
essentially
right,
to
bulk,
other
yeah.
people. And if the non-performing bucket goes to a certain percent the performing goes to a certain percent
Might
of
be a problem.
non-performing, can trigger
Might be
problems
a
up
problem.
their
Right.
line.
Might be a problem.
So
Okay.
again, I wouldn't rely on that, but it's fascinating that there's these interconnected rationales why people would do different things when they feel they're protected. But circumstances change. Like we had COVID, nobody saw that coming, and the impact on the real estate market. So as I always talk about it at our meetings, in other words, there's always risk with all of this stuff.
Yeah, all the time.
If you're in a position where if it gets called and I can pay it off promptly, you're in the best possible position because you're not likely to create any sort of injury or problem for anybody.
Well, that's interesting that you say that because I'll cover one last topic, or maybe it'll be who knows. But okay, so you're familiar with the insurance industry, right? Very familiar
I used to do a lot of legal work for them.
for the insurance industry because they're
Yes.
insuring something. Well,
Yes. Yep.
in the sub two world, there's actually a company or two out there that are part of the assurance industry. In other words, you can buy a policy from them, and they will assure that that loan, if it does a due on sale clause, that they'll pay that off, and you pay an assurance premium
Huh.
to do that.
Interesting.
So if you think you could never qualify, or that you have other problems, maybe this assurance thing would be a value add to you if you wanted.
And they charge you,
completely
I think it's an
de-risk it.
annual, and they charge you an annual premium for the assurances that you're avoiding the due on sale clause.
There must be
Assurance.
some replacement, because otherwise you'd buy that policy and then you would call and you narc yourself.
Right.
You get a letter.
Well, usually what
So
insurance
you
companies
must
are
have some limiting.
limiting thing. Well, for I could imagine.
Or they
If-
wouldn't pay it off. You would owe them the money or something like that. In other words,
Right.
they wouldn't pay it off for you, but
They
you would.
give you a note.
Or
Yeah, you would owe them the money or something,
you-
right? They
or-
would guarantee the fact that that instrument stays in place.
temporarily, or they might say, "Will you got it at 3.5%? If it goes, we'll pay
yeah.
you the difference, so that you have to go get your new financing.
If you can.
You get finance. Well, that's an issue. You get financing at 7%. We'll pay you the in between 3.5 and 7. That's the kind of thing.
a lot of stuff.
I've never heard of this before, but that's the kind of thing they might do.
Assurance, yeah.
And read your insurance policies.
Assurance.
Because otherwise you'll get an attorney like me when your house burns down or whatever problem. There's dual causation issues with exclusion. Read your policy. Talk to your insurance agent about everything, about this sort of thing. You got to make sure insurance is in place on this property. You don't think, you can't just assume there's insurance.
Yeah.
Despite this subject to transfer.
All right.
Yeah.
And then last topic. Let's talk about the actual physical transaction of the sub two.
Right.
What has to be disclosed? So
Yeah, so let's say I'm
you're
the one.
selling.
I've got a 2.5% loan.
right,
the
you're
Holy
selling,
Grail.
and you're selling.
Right,
He's buying,
right.
but the loan's going to stay in your name.
Right.
What are some other disclosures that you have to do? Number one, and then what other things do you have to do, you as the buyer? So let's talk about the disclosures.
I
and
need
then-
to have insurance on the property, so I need to.
But no,
make
there's
it
already
right.
insurance on the
Yeah,
property,
that's
isn't
the
there?
Problem,
It's in
right?
Ed's name.
So we've got a bit of a problem.
Okay.
It's
How
in
do we
Ed's
deal with that?
name,
Let's deal with the insurance.
And I don't want it in Ed's name, because if the thing burns to the ground, it's going to be in Ed's name and the bank's name.
Right.
And I have to be Ed in this scenario. to
Right,
get
can't
the
do that.
bank to
Can't do that,
work. I
right.
have to call Ed. Maybe Ed's out of the country, whatever. So I want my own policy for it. So if the best case scenario is that they don't escrow for the insurance at this point, you de-link the bank from the insurance, and you put the insurance in my name and the bank's name, and then
What if the bank doesn't allow you to delink it?
well,
Then you have to
Then
let
you
the
have to
other
have an
insurance policy
agreement.
lapse.
you could have two policies, and that's a
Yes.
problem. It's
Okay.
expensive.
Yeah.
Or you could have an agreement with Ed in writing about how that's going to work.
But that's part of
in case
disclosure
you-
agreement, right?
That's-
How to
that's-
handle HOAs, how to
Those are-
handle
those
all
are
this
some-
stuff.
Yeah.
So put broadly, I think because the sale and the house is done and the sale is done, you would need some sort of two things: disclosures, and
Yes.
if nothing else, just to be nice. And you don't want somebody
Yeah.
getting into a situation
And
they don't
cooperative.
understand. Cooperative, and that spells out what happens. If this
Right.
happens, you need to do this. If
Right,
this happens,
right.
and also to put in the agreement that you could put in there. If there's a due on sale thing or whatever, I have to pay it. I have to pay the
that's right.
law. Or in
I'm
this case,
I'm
Sam's
obligated.
buying
I'm
it for me.
obligated.
We're
Yeah.
both obligated to do different things. A typical contract. You have to do A, I have to do B. I have to give you money. You have to sign this thing. You want to do it or not? It's up to you. So disclosure of what's going on and
Also the
discussion of
tax and
somebody's
also the
rich.
taxes, right?
Uh,
where's the 1098 going?
Exactly.
Right,
Well,
because the 1098 is going to continue to go to your name,
right. Well,
but Sam the buyer actually is paying the mortgage, so he gets the 1098 write-off.
Right.
But the 1098 still in your
He
name.
doesn't.
How do we deal with that?
He probably wouldn't get the 1098 playoff because it's not living there. So
No, he owns it.
But
and he's
as an
paying on it.
as an
Well,
investor.
This is an investment.
Yeah,
So the interest I pay as an investor doesn't have to
correct.
be as you described with this 1098. I can just report it.
You
as
can just write it off.
Write it as an
It's a
expense.
cost. It's an
But
expense.
wait a minute, though.
The
Hold
bigger
on.
the bigger question
Hold
is
on,
what
Mr.
happens
Tax.
with the original buyer,
Wait a minute, Mr. Tax, guys.
the original seller.
So now we have a double case of writing off interest.
No, well,
He's writing it
he's
off,
not
but he's
allowed
paying.
to.
No. Why do you say that? He's got the 1098.
Yeah, well, just
Why is
because
he not
has
allowed?
a 1098 doesn't mean he can defraud the IRS. I could print you a 1098, but doesn't mean you can use it.
Right.
You have to. It has to
Okay.
reflect accurate information.
All right.
Right.
Just wondering.
Yeah, just because you have a form doesn't put you in charge. You have to have done what the form says, right?
But it's another example of risk or thing that you should probably spell out or work out, because if you may say you may receive a 1098, it's not tax deductible for
SSP.
you. You won't attempt to.
Scam.
Yeah.
Scam, scheme, and a plan.
Well, that's the
you
problem.
get the 1098.
Right.
You can write that off on your taxes.
I could
who's
lie.
Who's gonna catch you? No one's
The
gonna catch
IRS.
you. How are they gonna link?
Because the day they check with you and ask you to see your paid receipts, and you'll be like, I don't have any.
Oh,
Yeah.
I see.
Yeah.
You get,
But they're gonna have to link
But
your
this is
1098 to you.
So this is common, though. This is like, we're paying voluntarily within the compliance system. Anyone can cheat the system, but you have to make a decision.
Right.
If you're going to be a
Right.
cheater or not.
You're gonna be a cheater. Or
So
you're
if
gonna.
you're going to
right.
be a cheater,
well,
you
that's
just
why they.
make your own 1098 any day of the week.
Yeah.
Just send it in.
Yeah, because the IRS system is, they call it a self-reporting system. You're supposed to report accurate information to them.
Yeah.
So, but this is a great discussion because it's not as simple as some people think,
That's
and
right.
you
Yeah.
really
There's
want to
always
have an
a-
agreement.
There's nuances.
and
A lot of
nuances,
nuances.
and again, try to do the right thing.
Right.
Spell out. Don't trick somebody and think they're not going to tell them, oh, you'll never have to think about it again. You say you probably won't have to think about it
But
again.
I might have to give you a call.
But here's a couple
Yeah.
things that I might have to do, and call me anytime if
Right.
you get a bill or something,
Right.
because you shouldn't. And that's my obligation.
Yeah.
And spell it all out, and everybody, between the two of you will be happy. And then if something you didn't anticipate comes up, you're just going to have to deal with it.
That's informative. There's a lot to sub to.
A lot too.
Yeah.
But it's a great tool in your financial toolbox.
Yeah.
This is a great way to get lower interest rate loans on properties. It's a great way to buy a property if you can't get if you can't get qualified for a loan, if you're
Yeah.
what we call non-bankable. This is a good way to actually buy a house.
Because you don't have
It
to go
is.
through underwriting and all
It
that.
is.
through
It's very
underwriting.
good that way.
Yeah.
Well, this has been very good.
Thank you.
Okay. Thanks.
Yeah, thank you.